This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carroll and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
Good afternoon. This is Scarlet Fu and Norah Mulinda in for Tim Stenivek and Carroll. They are on their way to Los Angeles for Bloomberg's Screen Time conference. And of course, we will take you there to them in the 3 p.m. hour. In the meantime, Norah and I are keeping their seats warm, and we're keeping an eye on what's coming out of the Federal Reserve. And let's go now to Michael McKee, who is standing by to give us, we're going first to Charlie Pellet. I got ahead of myself. Charlie Pellet, give us the latest.
Let us begin with the U.S. equity markets as we await those headlines. The S&P right now trading at a record. S&P 500 index up 36, 67.51 where we stand. That is a gain right now of 0.5%. We have got the Dow up 70 now, up by 0.1%. NASDAQ up 213, up by about 0.9%. The 10-year 4.12% with the 2-year 3.58%. Gold, big story there, 4,051. First time ever above 4,000. Trading at a record up 1.7%. West Texas Intermediate crude up by 1.6%, 62.74 a barrel. Right now, Bloomberg Businessweek Daily continues. Back we go once again. Your hosts, Scarlet Fu and Norah Mulinda.
All right, Charlie Pellet, thank you so much. And now we go to Michael McKee to give us the latest from the Federal Reserve's minutes from its September 16th to 17th meeting. Mike, what are the key headlines?
Well, the minutes say that almost all of the participants, which is Fed speak for all but one, supported a quarter-point cut at the September meeting. Stephen Miron, of course, the new governor, was the only one who wanted a half-point cut. But the minutes do suggest there were some more hawkish views. A few participants stated there was merit in keeping the federal Fed funds rate unchanged at this meeting, the minutes say, or they could have supported such a decision. And most participants emphasized upside risks to their outlook for inflation in the discussion about the economy. Much of that discussion revolving around inflation, with the hawks noting progress towards the Fed's 2% target had stalled, which raised the risks of inflation expectations rising. The weakening of the labor markets carried the day, however, officials indicating their outlooks for the labor market were uncertain, and they viewed downside risks to employment as having increased. They cited a number of indicators, including low hiring and firing rates, concentrated job gains in a small number of sectors, and increases in unemployment for groups that are traditionally showing greater sensitivity to the weakening economy, including African Americans and young people. There were a range of views, the minutes say, about the degree to which the current stance of monetary policy was restrictive and about the future path of policy. Most participants judging that it would likely be appropriate to ease policy further over the course of the year, but some noting by several measures financial conditions suggested monetary policy may not be particularly restrictive, which suggested a cautious path ahead. There was a brief discussion of the balance sheet, but reserves continued to appear abundant, the participants felt, and no changes were suggested. So the minutes kind of tell a story of a divided Fed. And that's what we got basically in the dot plot, with almost even division between further cuts and some people wanting just one and some none.
So clearly a divided Fed here. And of course, we have a Fed meeting coming up later this month here. And the dual mandate still remains paramount here: maximum employment and stabilization of prices. Where do you think the Fed should really be focusing on right now?
Well, you have a real division on Wall Street about that. A number of economists are pointing to the inflation figures that we have seen lately and suggesting that we have not yet seen the worst of the tariff pass-through into inflation and prices, and that is something to be concerned about. Others are still concerned about the weakening of the labor market and the idea that suggests a weakening of the economy ahead. But there's also a division in terms of labor on whether this is a supply problem because the administration has deported so many people who aren't now going to be able to take jobs, or a demand problem with companies seeing the economy slowing and not wanting to produce as much. The bottom line is the Fed would like to have a lot more data to give it a clue as to which way we're going this month. but they don't have it right now. So the tough thing is going to be using alternative indicators to figure out where they are and what that might be telling them they should do.
Mike, you mentioned that there was just some mention of the balance sheet. It seems like this is becoming a hotter topic of late, with market participants hoping for some more guidance on this. Why is that? Why is this rearing its head right now?
Well, we're getting to the point, Scarlet, where market participants in the money markets are suggesting that we're getting to the level of Fed funds reserves that are at the borderline for whether or not they are where there's enough available. We did see a 1 basis point jump in the effective Fed funds rate recently, and some people were pointing to that as a sign that this is coming. So the question is, when do they stop QT? When do they stop their overall reduction in the balance sheet? And it doesn't appear that on the 16th and 17th they were ready to do that. They still felt reserves were abundant enough, but it does suggest the fact that they brought it up, that they're getting closer to the decision point.
All right, Mike McKee, thank you so much. Mike McKee is our international economics and policy correspondent, joining us from Washington with the latest headlines from the Federal Reserve Open Market Committee's minutes from their meeting last September, yeah, it was a month ago, at which the Federal Reserve cut interest rates for the first time this year, beginning what many people in the market are pricing in is a cycle of rate cuts. I want to bring in now Herr. She is U.S. CIO of Global Fixed Income, Currency, and Commodities at JPMorgan Asset Management. And Kay, do you think that we got anything new from this latest Fed minutes? I mean, we knew that Stephen Miron was an outlier, and these minutes certainly showed that. But what did we learn in terms of the debate going on inside the Federal Reserve?
So, Scarlet, first off, I'm glad to be here. Thank you for having me, and Norah, too. Second off, I think the short answer to your question is no, we didn't learn anything new. And I think one of the best ways to think about whether we've learned anything new is what the market's reaction is. And the market's really not giving us much of a reaction. Maybe at the margin, the minutes are showing us that that there was some discussion about maybe we didn't need to do anything. But it was pretty clear that we only had one dissent when that was released, September 17th, and not a lot of new information in the minutes today.
Okay, not a lot of new information. And of course, as we're looking at the trade, still green across the screen right now, all across the board here when we're looking at equities in particular. But what do you think the Fed should be focused on right now?
It's such a great question, Norah. As everybody knows, we've got a government shutdown, and we are in an absence of data. So the Fed, or the Bureau of Labor Services, did not release the employment data on Friday. It's unlikely, unless the government reopens, it's unlikely that we're going to get CPI next week. So what are we looking at? What's the Fed looking at? The next major piece of data that we think is two things, I would say. The first is corporate earnings start on October 14th, and I think that can be a great indication of what we're seeing from a bottom-up perspective on the economy. The second one, on a macro perspective that I'm sure the Fed will look at, is the Beige Book. So we've got the Beige Book coming out on October 15th.
Yeah, and I feel like the Beige Book has taken on greater importance in this period of uncertainty, where we're not sure if companies are passing along higher costs to their customers or how they're dealing with it. We're kind of in uncharted territory, and every company is doing things differently based on the experience of their executives. When it comes to corporate earnings, Kay, as someone who is in the fixed income market, what do you watch for? What do you look for? Is it the banks that will really tell you the most about what kind of credit quality we have in this economy?
Sure, that's a great thing to think about. I think first off, you know, we're not entirely in unprecedented territory. We have had government shutdowns before, and when we take a step back and think about the overall impact to gross domestic product, it tends not to be that material in the grand scheme of life. So from an earnings perspective, I think we're going to be looking for a couple of things. Number one, from the banks, what's the credit quality look at? What's the indication of the consumer? As we've seen in the macro data, we've seen some softening in employment. So is that going to flow through into reserves, into credit quality in banks? And then from the broader companies and the industrials, what are we seeing in revenue growth versus EBITDA, obviously, or earnings before interest, taxes, depreciation, cash flow, as it were. So what are we seeing in cash flow? I think for the most part, companies have very high margins, and are they going to protect those margins, or are they going to pass through costs onto consumers? And then what's that going to do to demand? I think that's what we'll be looking at.
So as we head into earnings season just around the corner here, what sectors in particular are giving you the most concern just based off of what you were saying?
I'm a bond portfolio manager. I'm paid to worry and lose sleep. So everything gives me concern. You never know where you might see a pocket of distress, and it's the unexpected that are the real concerns.
Well, we've seen pockets of stress in the auto sector. When you look at First Brands, when you look at Tricolor, what does that tell you about the state of the consumer, especially at the lower end? These were two credit blowups that took people by surprise. And a lot of people will say, okay, it's idiosyncratic. There are some maybe fraud issues that are particular to those companies. And that may be the case, but these are also sectors that are very much affected by tariffs. And they are not the only ones affected by tariffs either.
So I think there's a couple of things going on here, Scarlet. And yes, on a certain level, Tricolor, and apparently that's how it's pronounced.
Oh, thank you.
Yes,
I didn't know that. Okay.
That's your pro tip.
I've been saying Tricolor for months.
No, it's Tricolor.
Weeks, really.
I think there's a couple of things going on. Tricolor in particular, and I'm not going to talk about specific credits, but I think we should take a step back and think about what's going on in the broader economy and broader financial markets. And the reality is there's a lot of cash sloshing around. And when there's so much money sloshing around, that tends to be the point late cycle where excesses happen. So that tends to be the point. If you went back to the 2000s, you tend to see, it's not uncommon to see corporate malfeasance. And it may be in these types of instances where are seeing corporate malfeasance. To answer your question with regard to the consumer, we had been talking for a while about what we referred to as a K-shaped economy, and that was high-income consumers with a lot of exposure to stock markets, and were doing very well. Lower-income consumers had been hit with inflation. It actually, that seems, lower-income consumers seem to have stabilized some. We're more focused and concerned about maybe more prime consumers that are going to start repaying student loans and looking at defaults and type of behaviors that we're going to see there.
So let's dig a bit deeper into the lack of data that you pointed out just a bit ago here. So we have traders that are really bracing for a range of Fed outcomes here. Some of them even hedging flows, flavoring outlier dovish scenarios, and others focusing more on the possibility that the Fed forgoes a move at one meeting. How are you thinking about all this right now as it relates to the bond market?
Yeah, a couple of things. I think if you look at what the market is pricing in now, a 25 basis point rate cut is almost fully priced into the market for the October meeting. I think is it October 25th? So that's almost fully priced in.
October 29th.
29th, right. Sorry. Right
No.
Halloween,
I mean,
right
how could you not know this?
Yes.
How could anyone not know this? Just kidding.
So the market's pricing almost an entire rate hike in October. And then on the December 10th meeting, the market's pricing another, let's call it 20 basis points, something like that. But I think the other interesting aspect is that volatility in the rates market has been very low. So you get this base case that the Fed continues to ease. And if we go back to the Fed minutes and what the Fed said on the last meeting on September 17th is that they are saying that they intend to do 2 more cuts this year, and that's the base case. I think in periods of economic uncertainty, and the government shutdown is perpetuating that uncertainty because we're not getting regular economic data updates, then I think that logically follows that people worry about tail risk outcomes, and they look at unusual patterns in behaviors or in particular markets and worry about what they could glean from those.
So we don't have any data right now. What we do have are the government auctions of U.S. Treasuries because we need to raise money. So that continues. Is the risk of a tail event tapering off a little bit here? For a while, people were monitoring every single auction with bated breath, and it feels like we're excelling a little bit here.
We still monitor them with bated breath, and I think off the top of my head, today's auction at 1 o'clock was something like 91% end users and something like a tail of 0.45 basis points. So you're right, that's a strong auction, and I think that has settled down. I think concerns about the U.S. government, U.S. Treasury as a safe haven have abated as people have gotten more comfortable with the macro environment and the geopolitical environment.
So safe haven here may be abating, but what do you think is the next story here?
Next story. Gosh, I don't know. I'm not the reporter on this. We're just, we're just. I'm going to leave that to you,
in
Norah.
the market.
I'm in the markets. I think it's probably earnings. I think it's going to be. You've got earnings kicking off on. Look, as you all said, in the absence of any macroeconomic data being released by the federal government, I think people are going to obsess about every single earnings release and anything that they can glean from that. Specifically, as you all know, there's been an extraordinary amount of investment in AI and maybe starting to look for returns on that, look at that investment cycle. Right. So I think that's going to be important. I think to Scarlett's earlier question, always credit quality, return of capital to shareholders, increases in dividends, looking at flows. I think that's the next story. But yeah.
Where do you want to be on the yield curve?
Yeah, we still like the belly of the curve.
Everyone loves the belly of the curve.
Everyone loves the belly.
Isn't that just fun to say, though? The belly of the curve, right? We fixed income geeks. But yeah, I think we think that the rates are going to continue to be pretty range bound here between 3.75 and 4.25, and we continue to like high quality intermediate duration credit. As my dear colleague Ian Steely says, spreads are tight, but yields are right, and that's really what the driver is for investors. They're not investors who are thinking about investing for pension funds, endowment funds, individual investors. They care more about what the yield is, not what the spreads are.
Mm-hmm. So, of course, as we mentioned, the belly is what everyone's talking about. But is there any sort of opportunity on the other end?
I mean, there are always opportunities, but where we are most comfortable in the yield curve is really in the belly.
What about gold? I'm curious what you think about the relationship of gold to fixed income these days. Gold continues to zoom higher, now $4,061 an ounce, and just pierced $4,000 this morning.
Insane.
Yeah. So, and there seems to be very little that people can identify that's going to stop this momentum. It's driven by inflows into gold ETFs and also central bank buying. How does that play off of what's happening in treasuries, or doesn't?
Yeah. So you've just hit on a key aspect of it, Scarlet. So there are obviously two components of any market, supply and demand. And you just hit the two main components of demand, and that's central bank buying, and that's the ETF buying. I think the ETF wrapper is providing people with an easily accessible way to buy gold instead of buying bullion and storing it someplace. So you've got an increase in demand for gold. On the other side, if you look at the supply of gold, it's really been pretty constant. So you've got this mismatch between supply and demand. I think in terms of the relationship that we've seen, historically, gold has been correlated with real yields. So when you see real yields come down, gold prices go back up. So why is that? The opportunity cost is lower. If you can't get a high rate in treasuries or in risk-free assets, then maybe gold becomes more attractive. But what we've seen really post-pandemic, that relationship has broken down. And I think it's really a function of the supply and demand. But I think the point would be that that's broken down really over the last 5 years. So I don't read anything different in gold pricing about U.S. exceptionalism or the dollar or flight to currency or anything like that. I think it's old-fashioned supply and demand fundamentals.
You don't see it as part of the debasement trade that everyone keeps talking about?
Not really, no.
You don't buy into that? I guess someone who's the global head of fixed income, probably doesn't see much value in that, but had to ask it.
I mean, do you think we have more room to run here?
On gold,
yeah.
My only strong view on that is I like it as jewelry, as you can see from my necklace. I'm not enough in the weeds on supply and demand of gold to have a strong view on that. I think I've got a good handle on what's going on, the fundamentals and why we've seen prices going, but I'm not a technical analyst on gold and whether we've got more room to run.
All right, Kay, always appreciate your joining us. Thank you so much for coming into studio. Kay Herr is U.S. CIO of Global Fixed Income Currencies and Commodities at JPMorgan Asset Management. All right, did you know that the outgoing French Prime Minister is speaking in Paris right now? Let's go over to Connan, Bloomberg News reporter, on the latest from the French PM's Sebastian Lecornu's conversation. Caroline, what can you tell us we've learned here?
This is very much happening right now because the outgoing Prime Minister, Sébastien Lecornu, who resigned on Monday night and was given by President Macron 48 hours to try and find a solution, is saying that he has spoken with President Macron tonight for more than 1 hour, and he has told President Macron that after speaking with all the parties in the National Assembly, President Macron should be able to name a new prime minister in the next 48 hours. That's not going to be him. He says his mission is over. But of course, the question was President Macron going to be forced to call for new snap legislative elections, or perhaps even resign and call for new presidential elections? Those prospects seem to be going away as we speak, at least according to the outgoing Prime Minister, Sébastien Lecornu, who's been holding for the past 48 hours discussions with every single party from the center right, from the center left, except the extremes who didn't want to meet him. And there is a lot of fragmentation, as you know, in this National Assembly in France since President Macron called snap elections in June 2024. And that created this situation when there is no majority. Of course, at the heart of the discussions, and probably Sébastien Lecornu is going to talk about this right now on national television, is the pension reform, that very sensitive subject, pension reform which passed in 2023 after months of strikes and protests in the street. This is at the heart of the negotiations because the Socialists have said that if they come back on board, if they don't vote the next vote of no confidence against the next prime minister, then we have to have some sort of discussion or suspension of this pension reform. And they have also called for the possibility of having a socialist prime minister next. We'll see if that's the option that Macron chooses over the next 48 hours.
Well, lots to really keep an eye on there as we continue to follow this story. Thank you so much to Caroline Connan. Moving over to what's going on right now in the news of the day. Let's do that with Charlie Pellet.
Here's what's going on. Let's recap, reset, because we got those Fed minutes just 21 minutes ago. Fed officials did show a willingness to lower interest rates further this year, but many expressed caution driven by concerns over inflation at their policy gathering last month. Now, little response in U.S. markets. The S&P trading higher by 40 points right now, up 0.6%. 10-year, by the way, 4.13%, with the 2-year 3.59%. S&P at a record 67.54. We're at session highs now. The Dow up 80. That is a gain of 0.2%. NASDAQ higher now by 1%. Again, the 10-year 4.13%. Gold is surging $60 the ounce to $4,044. The precious metal up by 1.5%. West Texas Intermediate crude up 1.4%. 62.62 a barrel. And Bitcoin right now is up 1.4%. 123,699 on a Bitcoin. ExxonMobil has signed agreements that lay the groundwork for it to explore Iraq's giant Majnoon oil field, ending the company's near 2-year hiatus in the country. Exxon was among the first Western oil explorers allowed into Iraq, the second largest a producer in OPEC. Exxon moved in 2010 as the nation sought to rebuild its energy industry in the aftermath of the country's invasion. ExxonMobil shares today advancing with the price of oil. ExxonMobil up now by just about 0.2%. So again, recapping, Fed officials show a willingness to lower rates this year, many expressing caution driven by concerns over inflation at their policy gathering last month. Gold at a record, S&P also at a record, up 39. The S&P at higher by 0.6%. And for on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you, Charlie. Lots to keep an eye on in the market right now. Taking a look at the market, green across the screen, S&P 500 up about 0.6%. The best performing sector, Very much so expected. Information technology. It's really been a story for quite a while here. You're seeing this, a lot of optimism for traders here as they're really pouring into the growth story here. And we've got such a great individual here to discuss what's going on in that space. The CEO of Rubrik, of course, we know this is a cybersecurity and data management company that helps organizations protect, back up, and recover their data, especially after attacks like ransomware. Bipul Sinha, of course, the CEO here, want to chat a little bit about what your company is doing right now in this space. How are you using AI, automation, or data analytics to really stay ahead here?
Thank you so much for the opportunity. Rubrik is the security and AI operations company. We help our customers recover from, as you said, ransomware attack so that they can get back into the business without disruption. Our fundamental thesis is cyber attacks are inevitable, and every business has to have assume breach, assume attack posture. And Rubrik helps them understand the risk of an attack and how do you recover from an attack so that your business is uninterrupted. And on the AI side, we are also helping our customers accelerate their AI journey, adopt more of their agentic systems. One of the big concerns around agents is agents can misbehave. They can hallucinate or they can get compromised by cyber actors. So we are giving them a rewind button so that if agents take actions that are not desirable, they can just press the rewind button and undo the action of misbehaving agents.
Beyond misbehaving agents, as more companies adopt or implement AI, does that make them more vulnerable to attacks like ransomware? Does that open up any vulnerabilities?
Obviously, more AI adoption, more agentic adoption actually creates a larger surface area of cyber attack because you have more software. But at the end of the day, AI is 100 times more opportunities and 100 times more risk. On the risk side, now AI agents can do 10x more damage in 1/10 of the time. So business have to have the confidence that they can deploy agents, they can do AI transformation, create an AI enterprise, deploy AI worker without the risk of AI. And that's what we are focused on. How do we reduce the risk and give our customers more confidence to do the AI transformation?
Well, you really underscored the idea that AI can be an asset here, or it can really cause some real damage. So how are you thinking about balancing innovation with cybersecurity and data privacy?
Definitely the AI's aim is to increase productivity, but on the risk side, only the right data can go to the right person on the right platform at the right time. And that is the organization's goal. We are helping our customers understand the sensitivity of the data, have integrity and availability of the data and their services, and at the same time, if anything goes wrong, giving them a rewind button so they are confident about deploying AI in production, deploying agents to actually do real work.
When you offer them a rewind button, does it rewind everything? I mean, it erases all, the issues that they want to clean up, or is there some residue that simply can't be done away?
We give them a rewind button to completely undo the action of an agent, but it has to be done surgically because you don't want to take good actions out. And that's what we do. We give them full visibility on what has happened and ability to surgically undo only undesirable changes.
Interesting. How exactly does that work?
What we do is we give them a platform where we actually monitor all the changes by an agent and connect that back into the cyber resiliency platform that Rubrik has developed over the last 10, 12 years so that you can connect the action to the effect and then ability to undo the effects.
I want to ask you about consolidation in your space, in cybersecurity space. There's been a lot of talk that this is a crowded space. There are a lot of small companies, a lot of startups, and people have been waiting for waves of consolidation for a while now. But we have an administration that is much more open to mergers and acquisitions than the previous administration. How do you look at the landscape right now, the competitive landscape? Are there too many players right now?
Traditionally, cybersecurity, the way it evolved was it is focused on prevention and detection of attacks. And there are hundreds of vendors and tens of tools that average enterprise, 80 to 100 tools they buy to prevent and detect attacks. That space is super crowded, too many vendors, too much fragmentation, is still a number of successful cyber attacks. We are focused on the resiliency part of it, where we are saying attacks will happen. Are you ready to withstand an attack and keep your services up and running? So our space is a new market, new segment in cybersecurity, which is rapidly growing. But the older cybersecurity segment around prevention and detection has a lot of vendor. There has to be consolidation because businesses can't deal with 80 tools from hundreds of vendors and constantly juggling and having these disconnected systems. So you see Palo Alto Network, CrowdStrike, and others are making big headways in creating platforms that can connect all aspects of the infrastructure security around prevention and detection.
Understood. So, Bipul, I need to ask you: are you looking to, are you canvassing the market and looking to maybe add on to what your current capabilities offer? Are you in the marketplace are you a buyer potentially?
Always. We always look at our current roadmap and how do we accelerate this roadmap for our customers. We are always looking for great team, great technology, great products to acquire and accelerate our roadmap. We have taken this approach of organic and inorganic development, and we want to holistically help our customers do the AI transformation, create AI enterprise with confidence.
All right, I bring that up because Rubrik did announce a deal to buy Predibase back on June 25th for about $500 million. All right, Bipul Sinha, thank you so much for joining us today. Bipul is CEO of Rubrik, a cybersecurity firm and data management firm as well. All right, let's head over back to Europe because we now have some more details coming out of France, and I want to bring in Stephen Carroll. He is, of course, the host of Bloomberg Daybreak Europe. And Stephen is an expert on all things France. He's certainly my expert on all things France. We go to him constantly for the latest, and there's been a lot to stay on top of here. Stephen, Sébastien Lecornu, who is the outgoing Prime Minister of France, says that Emmanuel Macron, the president of France, can name a new prime minister in the next 48 hours. He can do that. He may not do that. Where does that leave us? What does this mean for his government?
Scarlet, things are a little bit clearer now than they were earlier today, but not much. What we know is that the theory that fresh elections could be called for the National Assembly looks less likely than it did this morning, for example. What Sébastien Lecornu has just said on French television is that he believes there is now a political situation that allows Emmanuel Macron to name a new prime minister and take the next spin on this wheel that we've been on since June of last year of trying to build a minority coalition in Parliament that's able to pass a French budget. Now, he did this after the 48 hours of intense consultations with political leaders from across the political spectrum, not all parties, but most. And what he was trying to do was see if among those groups he could find enough support for central ideas that he believes that could lead to a budget. Essentially, he wants somebody else to take the reins from here. That's what he's told the president, Emmanuel Macron. He came to this interview this evening on French television straight from the Élysée Palace, where he spent an hour and 40 minutes with the president, briefing him on what he'd learned over the past 2 days. He now expects the president to name somebody else to take on the job, to lead those discussions. He was asked repeatedly, should it be a candidate from the left party? He said it's up to the president to decide. Should it be a technocratic prime minister? It's up to the president to decide. He has made it clear, though, is that nobody who's going to be in this government should have presidential ambitions for the 2027 presidential election. It looks like he's pointing towards a sort of technocratic arrangement, but very much involving the politicians who are in the National Assembly now, who are on the political scene, to be able to put that compromise together, because they have some pretty big issues they have to decide, and the calendar on this budget is already running very, very tight. So the rush is to try and get something done in time that can be passed through Parliament and actually keep the public finances running over into next year, avoiding the sort of emergency measures that we saw at the end of last year, which, as we know, didn't go down very well on the bond markets.
Can investors force the hand of the centrist parties who must decide whether to play ball with Lecornu or, for that matter, Macron?
Look, that's a really good question, because what we've seen so far is a little bit of tension in markets, but not something that our own economists or any of the market analysts that we've been speaking to would describe as a fiscal or financial crisis in France. This is still a political crisis. We have seen the spread of bond yields between France and Germany widen, although it did actually tighten a little bit today when Lecornu signalled this morning that he had been making some progress in these talks. Realistically, looking at it for markets right now, nothing's really changed in the past week or really since the middle of the summer when the last Prime Minister, François Bayrou, proposed his budget. They're still in this phase of negotiation. There are still signals that a compromise could be found. When markets will run out of patience with France is very much an open question. You don't have the cliff edge of a government shutdown in France in the way that you do in the United States, because the way it works is the system runs into sort of keeping the lights on measures where taxes are collected and public services operated. That's not a situation any politicians want to be happening. It's not a situation the public wants to happen either. But the cliff edge moment looks that little bit further away, at least for now. The situation that markets were most worried about is what fresh elections could produce, National Assembly elections, or in an extreme case, a fresh presidential election. Both of those look off the cards this evening, but things are moving very quickly, and who Emmanuel Macron could pick in 48 hours' time is going to be a very interesting question.
So very quickly, if legislative elections would be unsettling to investors, I'm guessing that presidential elections, Macron actually resigning, as some in the opposition parties want him to do, is not something investors would welcome.
No, indeed. I mean, that would be a much more dramatic shift in France's both fiscal approach and some of those big, heavy issues like the pension reforms, which is the central thing politicians here are fighting over at the moment. If that were to be disrupted, that would change the fiscal perceptions of France. We've also got some ratings agency decisions to look out for too. A presidential election would be very dramatic. A National Assembly election would be less dramatic. And getting a new Prime Minister, well, that could produce another shrug from markets.
All right. Thank you so much. Stephen Carroll, fantastic context there. Stephen Carroll is host of Bloomberg Daybreak Europe, but he is at least my go-to authority on all things in France, certainly the political crisis that has been brewing for over a year now. From New York, this is Bloomberg Businessweek on Bloomberg Radio. Blackrock is reportedly seeking cash from a Jeffries fund that is exposed to First Brands. This is the auto parts supplier that went bankrupt last month. We had reported today that a Jeffries fund or an asset manager controlled by a unit of Jeffries has an exposure of about $715 million in First Brands trade debt. So once again, Blackrock seeking some cash, looking to pull some money back from this fund controlled by Jeffries with exposure to the trade debt of First Brands. Norah?
Lots to keep an eye on right now in the market. I mean, as we're looking more broadly and we're just thinking about finance and everything that's going on right now, seeing a lot of green on the screen right now in across markets right now. S&P 500 up about 0.5 percentage point. NASDAQ charging higher, up about 0.9%. If you dig a little bit deeper back into the S&P 500, we're looking at info tech and industrials, the best performing sectors in the S&P 500. No surprise at all, Scarlet.
It's tech, yeah. And it's been the driver here for the stock market since the lows in April. And tech is powered by that AI story. It started off with the chip makers. It expanded to software. It's gone over to the energy sector. Now you've got names like Caterpillar caught up in it as well, because they make parts for energy sources that people expect will get a big boost in demand because of this drive for AI. You know, what's just as interesting as the stock market boom is the continued march higher in gold prices. Spot gold surpassing $4,000 an ounce. It is just on a tear, underpinned by inflows into gold ETFs and demand from central banks. And it's unlikely, a lot of folks say, that there's a lot to stop its momentum in the near term.
Right. People seeing it as a safe haven. It's the place that you want to be.
It's a safe haven, but equities, which are totally risk on, is also seen as a haven for some.
And there you go. This is Bloomberg.
This is Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
Norah Mulinda here with Scarlet, We're both in for Carol Massar and Tim Stenovec today. They're out in LA, Los Angeles.
They're going to be attending the Screen Time event. That's a live Bloomberg event in Los Angeles the next couple of days. They're going to talk to movers and shakers from the entertainment industry, the streaming industry, everything that's happening in LA. So lots of great content coming your way over the next 2 days. But first they have to get there.
Absolutely. They're probably having the time of their lives as they're on the way there.
On the plane.
On
sleeping.
The plane. Have to be, right? But let's look at what's going on in the markets, because there's a lot of fun happening here, too, here back in New York. We're joined here by Kristine Aquino, of course, Bloomberg News here. We're going to talk about some of the stocks that are really moving under the hood as we're seeing a day full of optimism, green all across the screen. What are you watching, Kristine?
Well, Norah, let's take a look at AMD. I feel like we have to be talking about AMD today and most of this week, really, because it is one of the biggest gainers. Shares, ticker AMD shares are up more than 10%, or rather earlier it was up more than 10%. Right now up just about 9%. Still a pretty hefty gain. That is up more than 40% actually on a 3-day winning streak. And they really are still riding the high of news earlier this week of their chip sale agreement with OpenAI, which the company says would unlock tens of billions of dollars in new revenue. Now, Bloomberg Intelligence analysts weighing in saying that it will help OpenAI diversify its chip supply, of course. And Barclays analysts also saying that rather than this being sort of a diversification play away from NVIDIA, this just really shows that the ecosystem is just desperate for more computing power, more investment, and it's not a crowding out. It's actually an expansion of that ecosystem to just bring in more players.
It's not a crowding out, it's just an expansion. I like the way they put that. Although I do wonder why we can't get more specifics than tens of billions of dollars in new generation of revenue, new revenue generated. I feel like that, that lack of specificity worries me a bit.
Yeah, I mean, I guess they're going to argue that, this is their long-term framework, right? So you got to think like further out into the horizon. At least that's going to be probably the selling point. But yeah, anyway, we'll see. But yeah, I mean, I think investors are just really happy to ride this wave.
Certainly,
no one seems to be willing to get off the train, even if there are signs of caution abounding. But yeah, it just keeps going. It's the gift that keeps on giving, apparently.
Right. It certainly is. And you're looking at Dell, which is a legacy tech name, an old school tech name that's gotten a big pop because of the AI play.
Absolutely, Scarlet. And yeah, so Dell benefiting from that as well, even though, as you say, it is a little bit more of an old school tech company. So shares at the moment, ticker DELL, those are rising as well, up more than 7%. Earlier, it hit the highest level since May 2024. So we also got a long-term update from Dell. They were talking about their growth estimates for sales and profits over the next 2 years. And that basically doubled. They had revealed that in an investor event this week. And again, the reason being cited by the company is demand for AI products. So the word on the street, though, very interesting, right? So Bloomberg Intelligence analysts saying that obviously their strong AI server sales definitely helping strengthen that outlook. And it also shows that there is durable demand and enough room for market share gains. The big question that Bloomberg Intelligence analysts are really honing in on is how does this square with their profit margins, right? Because this equipment, it costs a lot of money to make. It costs a lot of money to roll out. And is this something that would crimp those margins eventually? Dell sounded optimistic at their investor event, but that is still the big question for investors.
I think that's such an important point, especially after what we've learned about Oracle, right? There was that report that its profit margin in its cloud computing business. And I recognize that we're talking about different parts of the whole AI machine, but Oracle's profit margin in the cloud computing business is actually lower than what many on Wall Street had been anticipating. So as much as people are getting ahead and excited about what this means for new business, it's going to come at a cost, at least initially.
Yeah, it's all going to be about the margins, Scarlet, and definitely something to watch for the earnings season.
Last name that you're watching.
Watching Fair Isaac as well, which we probably all know as FICO. So ticker FICO. Those shares down more than 8% at the moment because it's not actually FICO specific news. It's news from its competitor Equifax saying that its Vantage Score 4.0 service will offer mortgage credit scores at $4.50 through the end of 2027. So this is a response to what we saw from FICO last week, which is that they will now sell credit scores directly to mortgage resellers, which sent the shares of their competitors plunging. So now this is a retort from Equifax actually saying that they're responding to FICO's, quote, monopoly-like doubling of their mortgage credit score prices to $10 next year.
It's really been quite the back and forth that we've been seeing between FICO and then its private competitor, Vantage Score. They're really duking it out right now, trying to see who has the most attractive opportunity right now. Lots of interesting stocks that you have picked out here for us, Kristine. That does it for Bloomberg Businessweek Daily. The close is coming up next on Bloomberg TV, and Bloomberg Businessweek continues on Bloomberg Radio.
And, I'm looking at a market right now that has peaked, at least for the moment. The S&P 500 still holding on to gains. The 8th advance in 9 days, Norah, higher by 0.5%. The Nasdaq doing even better because, as you've been reminding us, technology is leading the way today and this week. The Nasdaq at a record high, up by 0.9%. The Russell 2000 hanging in there too, gaining 0.75%. And yields are marginally higher. The 10-year yield at 4.13%. The 2-year at 3.58%. From New York, this is Bloomberg.